Welcome back to the Deep Dive, your guide through the maze of earnings calls.
Always good to be here.
Today, we're cracking open the Q3 2025 earnings from BMO, Bank of Montreal.
Yeah, and this wasn't just, a run-of-the-mill quarter.
No, definitely not. We saw strong numbers, clear strategic talk, and maybe cautious optimism from investors.
I think that sums it up pretty well. Cautiously optimistic.
So our mission, as always, cut through the jargon, get to the core insights, quick and clear.
Let's do it. There's a lot beneath the surface here.
Absolutely. Okay, results snapshot first. BMO had a strong Q3.
Definitely strong. Adjusted EPS. C, $3.23.
Which, importantly, beat the consensus estimates quite significantly. Markets like surprises like that.
They do. And revenue hit C, $8,988 million.
That's up 10% year over year, also beat expectations. So strong top and bottom line.
Exactly. And looking at credit health, the provision for credit losses, or PCL.
The money set aside for potentially bad loans.
Right. That dropped notably to C, $797 million compared to last year.
Which suggests better loan quality, or at least more confidence.
Both, likely. It's a good sign. And their core engine, net interest income, NII.
What they make on lending versus paying for deposits.
Stood strong at C, $5,496 million. And maybe more telling, the net interest margin, NAM.
That profitability percentage.
Expanded, up 17 basis points year over year to 1.69%.
So their fundamental lending business is doing well, margin-wise.
Very healthy, yeah. Managing rates effectively, it seems.
Okay, what about capital, the foundation, right?
Crucial. Their CET1 ratio, Common Equity Tier 1, was 13.5%.
Which is comfortably above requirements.
Oh yeah, comfortably. Gives them a solid buffer and flexibility.
And that translates into shareholder returns.
It does. Adjusted return on equity, ROE, improved to 12.0%. Shows they're using that capital pretty efficiently.
And for investors holding the stock.
Dividend maintained at lollied 63 cents per share quarterly. But the bigger news, maybe?
The buyback.
Exactly. A new NCIB normal course issuer bid for up to 30 million shares.
That's up from 20 million before, right?
Correct. A significant step up. Signals real confidence and a commitment to returning capital.
No surprise the market liked these results then.
Not at all. Favorable response. Reflects that investor confidence.
Okay, solid numbers, but one good quarter. There's just one quarter.
True. Sustainability is key.
So what's the strategy driving this? What's the longer game, especially on ROE?
Right. Management was very clear. Their number one imperative, the ROE rebuild.
ROE rebuild. Okay. What are the targets?
Ambitious ones. 15% ROE for the whole bank, and specifically 12% for U.S. personal and commercial banking.
12% in the U.S. P&C. That's a big target for that segment.
It is. It shows where their focus is shifting towards those higher margin U.S. businesses.
And are they getting there? What's the progress?
Tangible progress. Overall bank ROE is up 130 basis points year to date to 11.1%.
Okay, 11.1%, getting closer to that 15%.
Moving in the right direction. And U.S. P&C ROE hit 7.5% year to date.
Still a way to go for the 12% target there, but positive momentum.
Definitely positive momentum. And it's driven by four main things they outlined.
Which are?
One, boosting that U.S. P&C performance. Two, normalizing PCLs, getting those credit losses down.
Makes sense.
Three, improving overall operating performance, just running tighter. And four, optimizing capital use.
And they mentioned operating leverage.
Yes. The CEO highlighted strong earnings growth and positive operating leverage.
Okay.
For the sixth quarter in a row.
Meaning revenues growing faster than costs. That's efficient.
Exactly. And the CFO made a point of saying this isn't like pulling forward future benefits. It's sustainable.
That's a strong statement. Suggests structural improvement, not just a one-off.
Precisely. They seem committed to that trend.
Okay, so the strategy seems sound, progress is being made, but it all depends on the economy, right? And credit quality.
Always. The two are tightly linked for any bank.
So what's the outlook there, given the strategy shifts and the different vibes in the U.S. and Canada?
Management described the credit outlook as benign to improving.
Benign to improving. Okay.
And the chief risk officer said something quite significant. He thinks they've likely passed the peak for impaired PCLs in the U.S.
Past the peak in the U.S., that is significant. Suggests the worst might be over for bad loans there.
It's a key signal, yeah. Interestingly, this quarter, they actually billed $24 million in performing provisions.
Reserves for loans that are currently okay.
Exactly. But that was mostly driven by a better macro forecast for the U.S.
So optimism about the U.S. offset caution elsewhere.
Pretty much. It offset a build in Canada, where they still see Uncertainty, trade, fiscal policy, higher unemployment trends, those persist.
So Canada's still a bit more challenging.
A bit more uncertain, yeah. But overall, they said the uncertainty meter is less high than earlier this year.
Less high, why is that?
Better clarity, apparently, on U.S. policy, stability in the Canadian government, and maybe where interest rates are heading. But they're still watching geopolitics and trade risks closely.
Makes sense. Cautious optimism again. So the actual growth forecasts, Canada versus U.S.?
Canada, modest growth expected, maybe 1 to 1.5% in the second half of the year. Stable, but not spectacular.
And the U.S.?
More resilient, strong corporate earnings, good labor market, consumer spending holding up. They see that supporting growth into 2026.
That difference really underlines why they're pushing so hard in the U.S., doesn't it?
Absolutely. It reinforces the whole strategy.
Which brings us to those strategic moves and structural changes. They're unifying the U.S. structure.
Yeah, bringing personal, business, commercial, and wealth all under one roof, so to speak.
Yeah.
Unified leadership.
The goal being synergy, better performance.
Both. More cohesive for clients, better cross-selling, more efficient operations. Classic synergy play aiming to accelerate performance.
And what about actual loan growth in the U.S., specifically wholesale?
They're being selective there. Mentioned good net originations, but also intentional exits from low ROE relationships.
So profitability over just volume, pruning the less good stuff.
Exactly. Chasing profitable growth. They expect to get back to market growth, maybe Q4 or into 2026, but they're being patient.
Disciplined. Okay. And they're also buying and potentially selling assets.
Right. Buying Burgundy Asset Management. See, $625 million, all shares, closing by year end.
What's the angle with Burgundy?
Expanding wealth management, especially for high net worth and ultra high net worth clients. Capturing more of that lucrative market fits the ROE rebuild perfectly.
Makes sense. And the potential sale, Moneris.
Yeah, reports are they're looking at selling their joint venture stake with RBC. Could fetch up to US $2 billion.
Selling a profitable venture like Moneris, what does that signal?
Capital reallocation, most likely. Asking, can we get a better return deploying this capital elsewhere? Maybe into the US P&C, maybe more wealth acquisitions, active portfolio management.
Constantly optimizing. What about tech? Digital, AI?
Still investing there.
Yeah.
Launched Lumi Assistant, an AI tool for their frontline staff.
To help customer service and efficiency.
That's the idea. Plus, they won a 2025 Salant Model Bank Award for payments innovation. So they're seeing current, investing and modernizing.
Important for staying competitive, for sure.
Non-negotiable these days.
Okay, let's pull back a bit. We've covered performance, strategy, the economy. What did the market make of all this immediately after the call?
The sentiment was constructively bullish. I like that term.
Constructively bullish, meaning good with solid reasons.
Exactly. Driven by the EPS and revenue beats, that clean PCL print, no bad surprises on credit, and the bigger buyback.
And performance versus peers backs that up. You mentioned the ADR.
Yeah, BMO's US ADR has significantly outperformed the Canadian Financials ETF over 1 month, 3 months, the past year.
Wider margins of outperformance too.
Much wider. It signals real investor belief in their strategy, especially that US angle. Seems to be the key differentiator investors are buying into.
So the story investors are hearing is
capital return via buybacks, targeted M&A like Burgundy, and strong core earnings, especially rate-sensitive earnings in the U.S. Those three pillars.
Looking ahead then, say the next 3-6 months, what are the key things for listeners to watch? Catalysts.
Okay, number one, that big 30 million share buyback. Need regulatory approval, then watch the pace of execution.
How fast do they deploy it? Got it.
2, the Burgundy acquisition.
Yeah.
Regulatory steps, integration progress.
Right. 3.
Updates on Moneris. If they sell, what happens with the cash?
Capital allocation again. And always the macro picture. Economic data hitting PCLs and NM. Those are the big external factors.
Makes sense. Okay, time for our favorite hypothetical segment.
Ah, yes. Where we stress this is not financial advice.
Absolutely not. Purely informational, exploring what ifs based on the call.
So today's idea, the North American growth arbitrage play.
Ooh, sounds fancy. What's the trade?
Simple concept, really. Go long BMO, buy the stock.
Okay.
And simultaneously short a basket of Canadian regional banks. The ones with mostly domestic business, less U.S. diversification.
Interesting. So betting on BMO against its more Canada-focused peers?
Right.
What's the thesis?
It's built right on BMO's own narrative. Their U.S. businesses driving profits, U.S. PCLs might have peaked, and they're actively optimizing for higher ROE, getting rid of low return stuff. While the other Canadian banks are more tied to that slower, maybe more uncertain Canadian recovery.
That's the bet. You're betting BMO's strategy and U.S. exposure give it an edge that will lead to continued outperformance.
And the upside isn't just the U.S. growth, but also the optimization. Shedding lower ROE assets could boost returns even more.
Potentially, yes. Turbocharging the returns, you could say, especially if the U.S. environment stays relatively strong. It's a bet on BMO's strategic clarity and that geographic advantage.
What are the risks, though?
Obvious ones. U.S. economy takes an unexpected nosedive. Or Canada recovers much faster than expected, closing that performance gap. Or maybe BMO stumbles on execution. It's hypothetical for a reason.
Definitely hypothetical. An intriguing idea, though, based on the diverging stories.
It captures the essence of BMO's current positioning.
Okay, let's wrap this up. To recap, BMO's Q3 2025 was strong. Good earnings, positive operating leverage, improving credit, especially in the U.S.
Yeah, and they seem very focused, very disciplined on that ROE rebuild plan. Strategic moves, optimizing capital.
Backed by management sounding cautiously optimistic, and the market reacting positively.
It really showcases a bank in transition, pivoting strategically towards what they see as higher growth, higher return areas.
It's a clear vision, certainly.
Makes you wonder, though.
Go on.
Could this U.S.-focused, aggressive ROE rebuild become a model for other Canadian banks facing slower growth at home? Or is BMO's situation unique?
That is a good question to ponder. Is it replicable? Something for you, our listeners, to think about?
Definitely food for thought.
Okay, please remember, everything discussed here today is purely for informational purposes. It is absolutely not financial advice.
Please do your own homework. Talk to a qualified financial advisor before making any investment decisions.
Thanks for tuning into the deep dive. Let us know your thoughts on the platform. We'll catch you next time.